I'm going to kick off today with something that's a little bit different than what I normally talk about. When I'm speaking to, and just, as Tracy said, I work mostly with clean energy or clean tech entrepreneurs, but the crossover with clean tech and manufacturing is a very strong one, and so there's a lot of ways in which they relate to each other. So I'm going to start off our conversation today talking about debt. How many of you like debt? Okay, I'm going to try to persuade you to like more debt. Okay. So I'm going to first tell you a little bit about our work in the clean tech space here as an incubator. Our goal is to help get technologies out of the university setting or out of a lab and into the marketplace. And when you're working with entrepreneurs and in the startup space, everybody automatically goes to equity. They're thinking about pitching to investors, right? Critical. Friends and family round, maybe getting some angel investment, etc. What they miss often is that they don't think about the role of debt in trying to build their company. And I'm not saying that you should all stop pitching. You should always be asking for money, right? ABC, always be closing. But you need to think about what's the role of debt in helping me build my company. Because it does have a role in certain cases and at certain stages. So what I'm going to run through today, because we're going through this very quickly to give you a little bit of a sample, and hopefully this is enough of a teaser for you to want to come back and talk more about debt. Yay! We owe money to other people. Is that this teaser will help you start just shifting your thinking a little bit, and it will help you, hopefully, depending on what stage you are, start thinking about how you're probably going to need debt in the future. Because if there's one thing we know about manufacturing in the clean tech sector, it's research intensive and it's capital intensive, right? And if you need capital, you're going to need loans. So if you haven't gotten a loan already to purchase capital for your manufacturing line or to do your research, you're going to need it soon. All right, so a couple of things. When you think about the cost of capital and the cost of equity, right? When you're getting equity, you're giving up a piece of the pie. When you're taking out debt, you're just reimbursing people for the risk, the bet they took on you. So that's a different calculation that we sometimes forget about because we're so caught up in what the interest is that depending on where you are in your stage, it might actually make more sense to just take out a loan and not have to deal with somebody else at the table every time you look at your cap table. Sometimes you don't want them involved. I want to talk a little bit about non-dilutive and dilutive capital, right? So in my world, Tracy mentioned that in one of my previous positions, I was running fundraising, so I know a lot about the value of getting grants and the value of non-dilutive capital. I also know the value of the hassle of getting grant funding, frankly. But in this case, getting a loan can be a very clean way of helping you get access to the cash you need to help grow or double down in research or execute on whatever plans you have without having to dilute your ownership. Something that we talk about with some of our companies is we discuss, how can you use working capital to get you to hit the milestones you need so that when you make the next ask, you have some wins in your pocket. So in a way, it's amplifying the role of that debt in building your business. It's not just about getting the new machine or building the new prototype or whatever. It's about getting those things and positioning yourself so that in 6 months when you make your next ask, you look like a rock star and you've really achieved and you've maximized that debt. And then the final thing is especially, when you're early on and you're sort of scrappy and you might get loans from your friends and your family, not only just equity, but you can obviously get loans through them, and we'll talk about other ways to get access to capital. At the end of the day, as you get bigger, you eventually want to hit the tier 1 lending institutions. Those are the large national banks, and they're the ones who eventually will get you the better quality capital with lower costs. So I just want to put that out there. These are things to start thinking about, that there could be a role for debt in your work. Now, here at the Clean Tech Incubator, we work with startups, so we're not really at the tier 1 level yet generally. And in fact, what we found is we had companies coming to us and saying, you know what, I got a big order, which is awesome, but I don't actually have enough cash to execute on it. So they end up in this sort of conundrum, right? Growing and yet hampered, hobbled, right? Because they don't have access to the cash. So for us, there was a clear indication that there was a market need. What was fascinating, though, is that everybody told us they were interested in helping, but nobody could figure out how to do it. When you talk to the tier ones, they said, oh, too risky. Oh, too small, too much due diligence. Because the hat that they wear is, as underwriters, they're analyzing risk. They are not like your investors. Your investors are looking at potential. So when you're looking at everything in terms of risk, you're looking for reasons to say no. And if you have a startup or you're an entrepreneur, you know there are lots of reasons probably in your business to say no. All right, so for us, we knew that we wanted to grow the clean tech sector here in LA, and so we were gonna have to play a role in solving this problem. And we were gonna have to actively go out and create a new mechanism to get financing to the early stage companies here in our ecosystem. So we went out and we won a grant from the Department of Energy to create something we're calling the Capital Access Program. We're in a pilot phase right now, and my colleague who couldn't make it here today, Dax Stevens, is working with our portfolio to identify companies that could actually qualify for a loan through the Capital Access Program. We've partnered with a CDFI, oh my gosh, Community Development Financial Institution, blank, to provide the financing and the underwriting, and we, as an incubator, are playing the intermediary role where we are matchmaking with them. And the goal is to just get it up and running, get a couple of loans out there, and then eventually in year 2, hope to scale it across the US to help address the needs in other incubators and the other clean tech ecosystems around the country. So of the 11 grants that were given, we were the only one focused on debt. So everybody's thinking about equity, and we're the only ones thinking about debt. And there's probably a reason why. It's really hard. Turns out it's really hard. There's a big cultural chasm. I sat at the table with folks who were working at the CDFI, and we were talking about capital, and they were talking about debt, and I was talking about equity, and it took me 10 minutes to realize we were using the same word for completely different reasons. So when we get into this as a topic later on, we're going to dig in deeper, I hope, to explore the ways in which capital can be viewed from a variety of angles and leveraged in a variety of ways to help you support your company. Excellent. So we're targeting loan amounts from 10 to 100K. You can see they're small, but we hope to scale that up over time. Quick touch on debt versus debt and equity hybrids. So you look at convertible debt. Many of you are probably familiar with that. So we'll want to talk about that. That's a great tool for a lot of the startups, at least our portfolio. And then venture debt is available for those more mature companies. And often has warrants, and so it's this idea of like, how do you partner debt to get you some cash, but also have those folks who are giving you that debt access to some equity. And then as a very tangible action item for some of you, you can always explore some of the tier 2 and tier 3 lending opportunities here locally in LA. This is just an example from LA Economic and Workforce Development Department. They have these 4 different programs. There's a Kiva loan program. They have their small business program that has to be run through HUD's approval process. There's a micro lending program, which I think is up and running finally, and then they're looking at a revolving loan fund. So this is the kind of stuff that we want to dig into deeper at the actual session and talk about what are some of those programs that are available for you to access as you help grow your business. One thing I will say as a caveat there before I hand it back over to Jim is for this kind of lending, there's really an impact, a social and economic impact that they're looking for. So they expect you to do things like create a new job and report on it, or grow in a certain way, right? So they're basically helping to subsidize access to capital in exchange for you to helping to support the broader economy with your mission or job creation. I think that's it.
We do have a couple minutes for a couple questions if anyone has some initial questions. And many of these people are going to be around afterwards to answer additional questions. I do think Amanda has to go off to do something else, so she's not going to be around afterwards right now, but we can follow up later. Anyone have any questions for Amanda related to this? Yeah.
In the process of learning about debt and making your portfolio appeasing or attractive to banks and institutions, is there some type of a learning process that individuals have to go through, and do you have anything in place?
Oh, I love that question. You totally picked up on that cultural chasm piece I was talking about. So what we've uncovered is that the underwriters don't really understand the clean tech sector. And so we spend a lot of time actually educating them about the business models and what it means to have a capital intensive company. These are not mom and pop barbershops, for instance, which is more what they tend to be used to. So there's a lot of education that happens there. And for our portfolio companies, not only do we talk about the sort of high level stuff I've been discussing here, but, I think somebody else will touch on this later, so I didn't bring it up, but different types of loans, like eventually you can go into factoring or inventory or wide. We'll be getting into that later. So there's a lot of sort of consumer education that needs to happen too, and we're building out a curriculum as part of our grant to present to our portfolio, and hopefully we'll have opportunities to share that with the broader ecosystem.